The following podcast was recorded on Thursday, May 5th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Hey, Kristen.
Good to see you. Today, let's talk about housing. There's a lot going on in the housing market. 30-year mortgage rates, as of the time of this recording, have hit a high at 5.27%, which is the highest we've seen since 2009. Lots of changes going on. I'm interested in your thoughts of what's driving the housing market, and if we start in particular and focus on Texas.
Sure. So there's a lot of things driving the housing market, and one of the things that I find most interesting is, we talk about the U.S. housing market as if it's some sort of monolith that you can look at from 30,000 feet and actually get a decent view of it, and that's typically just not the case, right? It's, first rule of real estate is location, 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 and it's the same with housing. Certain places have enough supply. Other places have way too little supply and will continue to have too little supply, whether it's because there's, no land to build on in desirable areas, or if it's the supply chain in general. We've significantly underbuilt housing following the 2008, 2009 housing crash. And, that's coming back to haunt us now with either rising home prices or generally just a weird market, even with rising interest rates. And, after the Fed meeting and the volatility there, who knows where mortgage rates will be in a week.
And let's take a look in particular. You've got a nice chart on Texas. What's going on there when you look at Austin, Dallas, Houston, Fort Worth?
Yeah, so it's an interesting kind of picture, right? Texas and, there's some other places, Florida, South Carolina, North Carolina, et cetera, have seen a huge influx of people during COVID, right? COVID, you could work from anywhere, why not sell a very expensive home in a very high tax area and move somewhere that is lower tax, and you can kind of trade up for a different home. So Austin is a tech hub, so you had a number of people in the tech world decide that they could move to Austin or potentially work from Austin during the pandemic. So you saw a huge influx of people there, and housing prices followed that. This is one of my favorite charts, is the median home prices spiked significantly in Austin. It spiked in Dallas to a certain degree, Fort Worth and Houston, but not as much. But the amount of sales and the amount of pricing over listing has just been incredible, particularly in Austin with that tech boom. What's interesting is, right now we're in the middle of an oil boom that doesn't appear to be letting up anytime soon. And you still haven't seen some of the larger, call it oil places like Houston, really follow suit. So that might be something interesting to watch, is that handoff from the Austin focused tech area to something like a Houston or potentially even a San Antonio in terms, they have the Eagleford, et cetera, in terms of where home prices are really going. So it'll be an interesting, call it time where maybe tech hands off to oil and you begin to have different regions do different things and really begin to see some pops.
How about if we take a look at the different coasts, for instance, West Coast versus East Coast? Owner's equivalent rent is about 33% of CPI. We're going to have a new CPI print next week. What's happening with the East Coast versus West Coast in rents?
It's really interesting because the West Coast is incredibly volatile. If you look at this, this chart, I mean, it's one of the places that got absolutely crushed during the Great Recession and has been an absolute fire coming out of it. I mean, this whole, call it owner's equivalent rent pop that we've seen recently coming out of COVID, it barely got back to 2017, 2018 levels so far. I think that's somewhat indicative of when you have a tech boom like we've seen in Silicon Valley, you're going to have those Silicon Valley, Seattle, all up and down the West Coast. You're going to see these types of moves in owner's equivalent rent simply because there isn't enough housing being built or enough multifamily being built. And those prices can go up if people are making more money. And as we all know, the tech sector has historically been a pretty good place to work if you wanted to make quite a bit of money. So when you have people with wages that are rising and rising dramatically and don't show any sign of letting up, you can raise rents. And so that's been a big part of the pop on the West Coast. The East Coast has been a little bit, call it more tame. Part of that is that the financial sector has struggled somewhat. You've seen outflows of individuals from New York, New York City, Boston, et cetera. So you've really begun to see a differentiation between the two coasts just based on what sectors dominate the markets there.
And how about the Midwest? We've got a chart, Midwest versus South. What's going on in the Midwest?
The Midwest is just a boom. So is the South, right? You've seen people moving there left and right. It's kind of the unknown middle of the country, so to speak. Midwest is, it historically has been kind of a boring and sleepy housing market. That's just not the case anymore. If you're looking for interesting spots, St. Louis has done incredibly well at attracting some tech talent, for instance. The middle of the country historically was cheaper, which means you can move there, you can move back home. If you moved away to go to the big city for a while, you can go back, get a home, and typically have a lower cost of living generally. Multiply that by the COVID effects of be on a laptop, work from anywhere. That's really changed the dynamic for the Midwest. The South is Florida, Texas, et cetera. Those are pretty attractive places to work from just based on tax codes. You've seen massive inflows there. There was an interesting article recently that showed how many Texans actually liked the inflow of people to the state, and 40% said it just wasn't a very good thing. And if you've seen the traffic in Houston or Dallas or Austin, it's understandable why. Yeah, it was not built for an influx of people like this, particularly Austin. So it'll be an interesting dynamic to see if there's any pushback given the interstate migration.
And we have a nice chart to share next on closing days. Let's look at by state. If you could talk again about that boom right in the Midwest.
Yeah, this is the interesting part, right? If you want to sell a home quickly, you're pretty much looking to sell in the South or Midwest, right? It's an interesting dynamic where if you're in the Northeast, you're looking at a much longer time frame to get that house off the market, right? 53 days in Vermont, 49 in New York, whereas you're 19 in Texas. I mean, that's 18 in Louisiana. I mean, those are pretty stunning turnover numbers.
Yes.
And part of that is that you simply don't have enough homes, right? If it goes on the market, it goes off pretty quickly, particularly if it's priced reasonably, right? If you're unless there's some dynamics, call it in the million plus type jumbo range. But those dynamics, aren't really applicable to call it the normal priced home. So I think that dynamic is likely to continue as we move forward. And it's worth remembering that crop prices haven't exactly gone down recently. We've seen tremendous increases in food prices. That's going to be good for the Midwest relative to the coast. The coasts don't grow much in terms of crops generally, and they're more of call it an interstate importer of food. And so you're going to have significant income transfers from the coast into the Midwest that allow for, call it, more of a dynamic housing market, more of a dynamic economy in general. That to me is a longer term story than people might be giving credit for.
Sam, how is this different from the last housing boom?
The last housing boom was highly speculative in terms of people owning 3-4 homes, flipping them, et cetera. This is really a story of not having enough homes to meet the demand, right? It's a demand shortage, or it's a demand overreach and a supply shortage. That's the differential in the dynamic this time around. You certainly might see some cracks in the housing market in terms of sales. Maybe prices begin to moderate as we have interest rates move higher. But at the end of the day, you're likely to see this be somewhat of a temporary blip, given that you simply don't have the supply that is being demanded by millennials that are finally buying homes, and some Gen Xers beginning to move either from New York or California and begin to buy homes.
So we touched earlier on today's mortgage rates, so the 30-year being north at 5.27%. How is this increase that we're going to be seeing in interest rates and mortgage rates, how's it going to impact the demand? Do you think it'll be as fast as they're intending? Is it going to be slower? What are your thoughts?
I think it's going to be slower in terms of the demand side. It's probably going to work through the price side more quickly than it will the actual fundamental demand side. That I think will be interesting. You might see a mix shift in terms of which homes are sold. You know, $1 million home has become much more expensive, but you know, a $300,000 or $400,000 home remains at least something that can be afforded, regardless of whether the 30-year mortgage is 5.5 or 5.6, wherever we end up next week. That to me is really the story here, is that you still have some affordability, particularly at the median home price, but you do have some demand destruction that's likely to happen in the quote unquote trade up market for homes. So I think it's going to be a bit of a give and take there. There's still going to be a significant amount of demand for housing, particularly if rents keep rising. But you're probably going to have some price mitigation and a little bit of a, call it a come down in terms of overall demand for the higher end homes.
And how about the supply chain constraints?
The supply chain constraints, you know, they're getting better on some, but they're getting worse on others. Right. It's, you know, you're probably going to be okay on the lumber front. We've seen an incredible amount of lumber being shipped down from Canada recently. That's going to mitigate at least some of the pressure on lumber prices. But you don't have supply chains for PVC piping or, you know, copper piping or, you know, electrical cables or shingles or a lot of those inputs that are pretty heavy on metals and crude oil. You know, shingles are made from crude oil. That's why they're called asphalt shingles. So I think that's going to continue to be a constraint overall in terms of the ability to build a home at a profit margin that's decent with rising interest rates. That dynamic I think will be a little bit more difficult on the builder side, but that's going to be a supply issue, not a demand issue.
So what should we be watching for next?
Watching for next, there was an interesting announcement recently that the U.S. government was going to bid on 60 million barrels of oil to replenish some of the stocks that they were using from the SPR this fall. That dynamic is a really interesting one to watch over the next couple of weeks because it creates somewhat of an incentive for oil companies, particularly the Permian and other ones that can turn on relatively quickly. It creates somewhat of an incentive for them to begin to pump more oil out of the ground and begin to put more CapEx in the ground. Whether or not you begin to have some announcements, that'll be very, very important over the next week or so to begin to hear. Whether or not that incentive that oil prices, and there will be at least a semi permanent demand for oil, even at these prices. I think that's really important for mitigating short-term energy problems, both in the US and Europe. So that's really what I'll be paying attention to, is what the tone is going forward for smaller producers in the Permian, Eagle Ford, and a couple of other places.
Well, Sam, thank you for your thoughts today, and thank you everyone for joining us. As a reminder, we are client driven. If you have any questions or feedback on future topics, please let us know. For further information on Arbor Research, Bianco Research, and Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Thanks everyone, and have a great day.